Welcome back. I'm interrupting Midcap Radar because we want to understand the Reserve Bank's unexpected announcement of a massive OMO purchase of bonds, or rather open market operations purchase of bonds, which they announced late Monday evening. The Reserve Bank said it will buy 1.25 lakh crore of bonds between May 6th and May 19th. That is, when they buy bonds, they put in that kind of money into the interbank market. The interbank market already has surplus liquidity, so this surprised a lot of market people. To understand what the Reserve Bank is trying to achieve, I have with me Samiran Chakraborty, Chief Economist at Citi India. Samiran, good morning, and thank you very much for joining in at short notice. Well, first of all, were you surprised by the announcement?
So, Latha, as things go, these OMO announcements have been much higher than where the market expectations have been. And I guess the primary reason behind this is that in earlier instances, the market was looking at different kinds of overnight rates and spreads of 3-month CD over overnight rates to understand whether there is liquidity stress in the system, or in other words, was looking at the price of liquidity to decide whether further liquidity infusion would be done by RBI or not. But now what appears to us is that the RBI has a certain quantum of liquidity target in their mind, and they are gradually building up through these OMO purchases towards that liquidity target, regardless of where the price indicators of liquidity in the market is. The overnight rates are already lower than the repo rate. The 3 months CD spread has collapsed almost 100 basis points from the highs about a month or so back. So that's not the primary reason for the OMO. The RBI is building towards that 1% of NDTL type of liquidity surplus as they move forward.
Okay, I take your point. Just to tell my lay viewers, the thrust of the Reserve Bank, according to Samiran, is that they're not anymore looking at the yield levels. Initially, bond guys used to look at the yield levels, and if it went higher than the repo rate or something in the call market, then you would expect Reserve Bank to intervene. Now the Reserve Bank is intervening, although the yield is below the repo rate. And as he sees it, that's because they want to keep the total amount of excess liquidity at 1% of total deposits, which is what NDTL means. But Samiran, therefore, what is their aim? Why would they want to keep that 1% NDTL? Is it for faster transmission of deposit rate cuts?
So it could be a mix of quite a few things. One possibility simply is that despite the significant OMOs that RBI has already done, the durable liquidity surplus still is lower than that 1% of NDTL. We think that number is somewhere close to the 2 trillion rupee mark rather than the 2.5 trillion rupee, where probably that 1% of NDTL is. And the banking system liquidity surplus, the frictional liquidity, is also not that big a surplus as yet. Now, the interesting thing is that in the month of May, the RBI is going to give a very large amount of dividends to the government, budgeted to be at least INR 2 trillion. That adds on to the durable liquidity, and at that point of time, the durable liquidity surplus would definitely cross that 1% of NDTL mark. Now, to what extent that injection of durable liquidity will be compensated by other types of absorptions of liquidity, whether in the form of higher currency in circulation, higher FX intervention, or for that matter, there's a large amount of FX forwards which are coming up for maturity. To what extent rollovers would happen or not happen on that front, everything will determine where the final durable liquidity is going to end up with. Our sense is that if the forwards, it's very difficult for us to estimate the forwards part, but without that, the durable liquidity surplus could end up closer to 5 trillion rupees is what our sense is. However, the banking system liquidity will not improve as quickly because it takes some time for government to use or spend this dividend that they will get from the RBI. But once the banking system liquidity improves, that's the time we will probably see more reaction on the deposit rate and the lending rate side. And there, I guess the main issue is that if the bond yields come down, then we have seen that with about a 6-month lag, the weighted average lending rate also comes down. Given how the bond yields have behaved in the past, our sense is that within the next few months, we should see the weighted average lending rate at below 9%.
Okay. Can you give us some idea, therefore, of where you expect the 10-year and the rupee to range over, say, the next 2 quarters?
So our sense is that right now there is a possibility that the 10-year comes below 630 also, which was our initial target taken long back. That's because the rate action as well as the liquidity action has been more than what we had anticipated at that point of time. However, we have to also be cognizant of the fact that in all earlier cycles, in the rate cutting cycle, typically the term spread, the spread between the 10-year bond yield and the policy rate, that widens further. So that's why the bulk of the reaction from future rate cuts, we think that at least 50 basis point of more rate cuts could be there. That could be more at the short end of the curve rather than at the long end of the curve. Although we have to see which particular segments the OMOs are happening to some extent, that might also impact the yields. But overall, not expecting a major action at the long end, more action at the shorter end is what our sense is. And on rupee, I think it's a tussle between where the dollar is going versus where the CNY is going. But our sense is that at this point of time, the bias is towards a very marginal depreciation, but a more range-bound rupee movement because inflation differential is collapsing quite significantly for India. And the fact that we have now built up substantial reserves as well, our ability to keep the rupee in a relatively narrow range is much better now.
Okay, a very quick last question, and it's more academic really. There is one part of the bankers who feel that because they have RBI has $80 billion of forward sell positions, buy sell positions, and maybe a large part of it is maturing. That is why this money. And there is the other one who was saying what you are saying, that there will be cash withdrawal and there will be CRR money going away. What do you think is the reason? Is it more the FX reason or is it more cash withdrawal, CIC and other reasons?
So obviously, as I was saying, that without the forwards position, the durable liquidity would end up close to 5 trillion rupees by end of the quarter. So it's possible that the actual increase will not be that much because of some forward positions being also extinguished. But it's very difficult to take a call that how much RBI will go on this front. But there is room for RBI to take this approach because the overall durable liquidity surplus is going to be so much that they would not be too concerned on that front. But I must say that it appears that the liquidity situation is being kept in line with the accommodative stance of the RBI's current monetary policy, which will make sure that the transmission of rate cuts are much faster.
Okay. Thank you very much, Samiran, for this unscheduled stop and explaining the policy to us. So there you are. It looks like the main thrust, as far as you and I are concerned, is that deposit rates should also fall as quickly as the repo rate is cut, which is obviously good news for banks and NBFCs.
Which shows the kind of moves that we have seen over the last couple of days as well, right? Latha, thanks a lot for that update. By the way, there are more updates on your screen. The second day of Ather's IPO subscribed around about 24% of the full issue. The retail portion is fully subscribed. The NII portion subscribed around 20%. The employee portion, though, subscribed almost 3 times the shares on offer. By the way, 24,350 is where the Nifty still continues to remain at, still struggling to cross last Friday's high. So meandering in a range as there is a tinge of caution that continues to persist on the street. But the defense stocks continues to move higher. Tata Technologies is at the lows of the day. Oberoi Realty 2 at the lows of the day. But with that, we call time on this edition of Midcap Radar. From Reemami and the team that put this show together, thank you so much for watching. MF Corner on the other side.